People hear a lot of myths around DSCR loans. Most of them come from not understanding how these loans actually work. One of the biggest myths is that DSCR loans are no doc loans. They're not. They're low doc when it comes to income, but the deal itself is still fully underwritten. There's an appraisal, there's title, there's insurance, there are reserves. All of that still matters. Another big myth is that DSCR means your personal finances don't matter at all. That's not really true. Credit still matters, reserves still matter, and your down payment definitely matters. The difference is just where the lender is looking for support. They're focused on the property, not your W-2 or tax returns. Another one I hear a lot is that DSCR loans are only for huge investors with like dozens of properties. That's just not the case. I see first-time investors use DSCR all the time, especially when they don't want their personal income to be the limiting factor on their first rental. There's also this idea that DSCR loans always have terrible rates. Yeah, they're usually higher than conventional, but not in some crazy unusable way. You're paying for flexibility. If the property cash flows, most investors are totally fine with that trade-off. Another myth is that short-term rentals automatically qualify. Some lenders allow them, some don't. And even the ones that do all calculate income differently. That's where a lot of people get tripped up. And probably the biggest myth of all is that DSCR loans are some kind of loophole or gimmick. They're not. They're just designed around how real estate investing actually works. If a property can pay for itself, lenders are willing to lend on it. That's the whole concept. Once you understand that, DSCR stops sounding complicated.